Hi, everyone. Welcome to BC Tech's panel on funding options for your startup at the Vancouver Startup Week. First and foremost, apologies for a bit of technical difficulties there. We're just adjusting to hop in, and this is a brand new platform for us. In any case, I am excited to have you here this afternoon for a conversation around funding options for your own company. I hope you have been enjoying the insightful sessions that we have so far. And usually when I'm speaking on behalf of BC Tech, we are at our hub location. Some of you might have been there. But with most of us doing remotely, I would like to acknowledge that we are grateful to be gathered on the Indigenous land, regardless of where you are joining us from. At my home in downtown Vancouver, I am grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples. BC Tech is a non-for-profit dedicated to making BC the best place to grow and scale a technology company and to advancing technology as an engine for growth in every company. We appreciate you making time for the Vancouver Startup Week panel with us, and the goal of this panel is to help you, founders, find other resource of funding to fuel your growth. You will hear from our panel of technology sector founders and founder. You see on your screen here, there's Mark Williams, advisor and previously co-founder of Elastic Path, Minal Sankar, CEO of Easily, and Praveen Farshni, partner at Farshni Capital. Welcome. So let's begin with a quick introduction. I will ask you to respond in the same order that I introduce you, Mark, Manal, and then Praveen. Mark, can you tell us what do you do? Like what's your entrepreneurial journey looking like? And we still have you on mute, Mark. So we're gonna have you unmute and then restart.
Can you hear me now? Okay. So I was one of the co-founders of Elastic Path. I was there for 16 years. I did multiple raises through that process. I was also heavily involved with other entrepreneurs and other equity firms during that time in understanding what it meant to raise capital and what the consequences and rewards are. That would be from anyone who's raised upwards of $400 million and then ended up being bought by a company and then in turn then started investing in other companies and buying other companies. And also friends who have started companies that have done friends and family, banks, etc. So I've got a lot of knowledge in this area. I wouldn't say I was necessarily an expert, but I'm enough to be dangerous. Good?
Thank you. We love to have your perspective here.
Thank you.
And Manal, over to you.
Hi, everybody. This is Praveen. Oh, sorry. I thought you were going to do it,
Sorry, we have Manal and then Praveen. I'm going to go over to you.
Okay. So my background, in my life, I've done everything from consulting, tech investment banking, venture capital, and have been an operator of startups. But currently, I am the CEO of Easily, which we started a few years ago. And we are an alternative lender. And specifically, we work with government programs to make them easier for small and medium businesses and startups to use for financing the way that they need them. We'll go into more detail about it later, but that's the brief synopsis of what Easily is.
Thanks, Manal. Praveen, over to you.
Hey, everybody. Thanks for having me. So my career, it's interesting, it went in 3 phases. So actually, I'm a CPA by profession, an accountant. And that wasn't for me to do forever. And I ended up joining my father, and who's also a CPA, and my younger brother, who's a lawyer. And we became entrepreneurs. So we had a 10, 12-year run where we started half a dozen different businesses. My roots actually are in the mining resource sector. And my first project was the finding and discovery of a diamond mine in northern Canada with De Beers. We spent $1 billion, and it was a good start to my career. And then eventually we evolved into tech and social impact. And then the last 20 years, we've been in this active family office called Farshni Capital. So we tend to invest in real estate, a little bit in mining still, and then primarily social impact, which is the bulk of sort of our investment. And then I'm also a very active angel investor, so that's sort of outside of the family office business.
Thank you, Praveen. Okay, so my first question is actually for Mark. Mark, you have advised many entrepreneurs in the community, so did the other panelists, but specifically for Vancouver founders, do you think that we tend to gravitate towards equity funding?
Please tell me if you can't hear me. I think Vancouver founders most of the time are looking for the cheapest funding instead of necessarily the right funding. I think that's more of a feeling I get, anyways. Um, and equity funding is one of the ways to get it. But I wouldn't say that there is any norm. It also depends on the industry that you're in as well, and what you've heard in the industry and how other companies have approached funding as well. So I would say more my experience in Vancouver is a lot of companies like to start with friends and family, which they seem believing that it's the cheapest way to get funding in order to start something, instead of looking at necessarily what's the right way to get funding, to get growth, sorry, to
I
get
like
growth.
what you say there.
Yeah,
You
I
say
mean,
something along the lines of you believe that the founders think that friends and family round or equity round is they believe that as the cheapest, but it sounds like you don't think that way. Is that so? Mark, you have to unmute.
I think they don't do all the research necessarily to understand that the opportunities that are at their front door. I think they hear and take in knowledge from certain areas and then think. One of the things I think we're going to get into is government funding is absolutely fantastic, but a lot of founders don't even do enough research to know how much funding there is out there that's free, right? Um, a lot of founders are scared of giving up equity, but at the same time, it depends on where they are in their business model, and it depends on where they are in the opportunity that's in the market, or whether or not they should do friends and family or not. They should probably go out and get equity that'll end up being cheaper than in the long haul than getting friends and family that actually ends up costing them more money. I'm just saying I think it's a mindset that it's about, I want to get kind of the easiest way of funding my business instead of thinking a bit more globally in the aspects of the world is large and that there's many different ways of doing funding. Vancouver to me is a very, they think like a village at times, some of the founders, and not like a globe, because there is lots of different mechanisms that are great for funding. So I wouldn't, in my experience, I wouldn't say it's they lean towards funding or not. I would just say that it depends on the vertical, and I just see tendencies, and I'm like, well, did you even know this existed? And they're like, no, I didn't even know that existed. You know, like things like Shred and IRAP, our Canadian government gives bucket loads of money away, and there's so many people that don't even do the research to know what amounts of opportunities are there. Bank financing for low amounts of interest rates because you're under 30 years old. So I just think that there's the cheapest way, and they don't necessarily do enough research. That's my personal opinion.
Anastasia, looks like you're muted.
Yeah, you're muted, Anastasia.
No, sorry. Agreeing with kind of like what you said, the kind of like a lot of founders that we work with didn't actually take a look at the whole scope of like the funding instruments before they decide like which one would be best. So I'm gonna hold the conversation here for a second, and then I want to jump into Manal and Praveen for here. So the two of you work with various different stages of company. So can you walk us through how do you actually work with technology companies, especially when it comes to government funding? Manal, can we start with you?
Sure. And just to piggyback on what Mark was saying, I couldn't agree more. I think people do tend to have certain tendencies. They have certain ideas in their heads about, well, I don't want to give away the company, so I don't want to take equity, or I don't like debt, so I'll never take debt, and tend to skew towards one thing or the other. When really, something we talk a lot about at Easily is that you want to have a diverse capital stack. And at no point do you want to put all your eggs in one basket. I also think there's a tendency to think that, okay, when you're younger as a company, that's when you need to look for grants and government funding, and then you don't need to do that when you're later because you can raise equity. But really, you should be weighing all your options and the full costs of them, not just what you're paying, but what does it cost you in time? What does it cost you in your ability to raise additional capital? How does it, encumber your company? Does it restrict you in other ways? So you really have to look at the full spectrum of costs when deciding that. And so I'm glad you brought up sort of Shred and IRAP, Mark, because easily we specifically work, one of our biggest products is Shred financing. And so the way that we think about it is we can work with companies at any stage, because this is government funding that you should be using as long as you're doing R&D. So there's nothing to restrict you from using it when you're at a earlier stage or when you're at a later stage. And it is a great source of financing. The other thing, that I would add is a lot of the times, like I said, people think about cost as just what they're giving up or how much they have to pay right now. But a big part of it is also how much of your time does it take? And it's when you're trying to figure out which investors or which lenders to approach, you should really think about all of those things. And so typically when it comes to equity, if you're too early, you have to give up a lot of your ownership in order to get funding out of it. So that's why typically people want to prolong each round as much as possible, so you have as much growth as possible, so that when you actually raise equity, you have to give up a smaller portion of it. And so one thing to keep in mind with that is each time you raise it, it takes a lot of time and effort to raise capital, whether it's debt, whether it's equity. And so being prepared, keeping your financials up to date, keeping an up-to-date sort of pitch deck, keeping an up-to-date cap table. And these days there's all sorts of SaaS software that you can use to do all of these things and keeping them up to date. And then really timing them well. So one thing you'll notice is whenever you're right after you raise a round of equity, that's the best time to then go out and put debt on top of it, or put everything else that you can, so that you can really prolong that and you can have as much cash runway as possible to get you to that next stage before you have to go out and raise the next round of equity. But if you think to yourself, I just raised a bunch of capital, I don't need to worry about this, I'm going to worry about it till I get to the end of it, it's a lot harder to raise money when you don't have the money. So when you have the money, that's when you should get as much of it as possible. And in terms of the government financing, the thing that I'll add on that is the way that we work with companies, because like I said, we work at every stage, we have a standard process, we really like to make it as easy as possible. And we think of the time that you have to spend as a really large cost. And so we make sure that we're getting company capital within 2 weeks. So you have a yes or a no, and you can kind of move on to the next thing that you have to do. The other thing is, like I said, you can use government funding throughout your lifetime. But part of the reason that we started Easily was the way that government funding works isn't often the way that companies work. Mm-hmm. So with Shred, for example, it's extremely valuable, but your expenses don't come once a year. And you actually need to be able to use them throughout. And additionally, you actually have to spend some money in order to get those refunds back. And so what we do is it's a bit more of a cash management tool, where we say, instead of having that you're getting sometime after you file your taxes next year, we can calculate what you've accrued every quarter and make sure that you're getting that every quarter. You can build it into your budgeting, you can forecast using it, and it's, as long as you're performing R&D, it can be an evergreen source of capital that you get every quarter, and now you can start to line up your expenses with the capital that you're getting from there.
Thank you, Mano. Yeah, I think kind of like that, having that flexibility on time is absolutely crucial for a lot of companies. You said something that I'm really interested to discuss further. whereas like right after you secure your equity funding, add the debt on top. So I thought it was like very interesting, and I would like to unpack that a little bit. But before we get there, Praveen, can we hear a little bit from you? Like, how do you work with technology companies? You touch on that a little bit by being an angel investor, but from your perspective, like what kind of companies you're typically looking for, and what you're looking for from a founder?
Yeah. So we invest in, and not just technology company, although I get asked by people, so you're a tech investor, what does that mean? And I go, well, actually, not every company is a tech company, right? It doesn't matter if you're making a widget, like you have to use tech to be efficient and scale, that kind of stuff. But in terms of fundraising, like the first thing I'd say is, you really ask yourself, do you really need to do a raise, and why? And does it make sense? And it's been kind of touched on by Mark and Manal, but like, you could have an early stage idea, and if you could raise some good money, you're probably going to dilute too much. So often you need to bootstrap as long and as far as you can before you get into any kind of funding, and to think about all the different ways you can raise money, because there's debt, there's convertible debt, there's SAFE, there's preferred shares, common shares, debt with an equity kicker, and I know they've got a couple of experts on all the various government programs, which are phenomenal, in Canada and the US. And then grants can be part of that. I love free money because, it's not dilutive, right? You don't have to give up anything. And then there's also some other sources that are, really creative. Like one that I love is customer funding. So if you can get a customer to help fund and still own your IP, right? That's a great way to, again, be non-dilutive. And then you've got, companies like Front Funder. So there's actually equity crowdfunding, which can be very successful. And to me, it's more for consumer type products, maybe some tech, and then just crowdfunding itself. Like you could sell, your product in advance. And again, it's non-dilutive. You've created some sales, build a bit of a marketplace for your product. So there's lots of different ways to raise money. And, Manal also touched on it too. Like when you're doing a raise, you've got two full-time jobs. You're still trying to run a business, and you're doing the business of the raise. They both take a lot of time, effort, attention, and maybe some budget. And so you're trying to get the raise done as quickly as possible so you can 100% focus on execution again. And she also touched on, it's interesting because with banks, like we all know, they're notorious for not lending you money when you really need the money. But when you don't need the money is when you go to them and you get your lines increased, all this kind of stuff. And it's the same with equity, because a lot of hard work to get, the raise done. And then the real work begins to deliver on what you said you're going to do with the money. But you're planting some seeds right away for that next round, because, like sometimes an entrepreneur will tell me, oh, this is the only round I ever need to do. And I've only seen a couple of businesses like that where they're just so cash flowing that they could just grow with cash flow. But generally, you're going to be doing another raise because you haven't made it to break even or profitability, or to grow faster, because most businesses these days are about speed to market. So, it's great when you meet someone and you start the conversation with, I'm not raising money, right? Because it's kind of like, I hope nobody on the call is an insurance salesman. I just like use it as an example. But, when you see the insurance salesman coming, like you're kind of like, don't come to me because you're going to pitch me insurance, right? So when you approach a potential investor and say, look, I'm not doing a raise, but, I just wanted to, explain to you who I am, what I'm doing. And when we do a raise down the road, love to come back to you. And in the meantime, can I keep you informed? And between now and then, I'm going to do A, B, and C. And then when you come back to them and show you A, B, C, and D, and E, you've proven to them that you're someone they want to back and invest in. And then I guess one other thing that I've learned from experience is it kind of touches on that concept of don't ask someone for money. But I find a great way to get to the money is to seek mentoring first. And so as an angel investor, I've probably invested over 100 companies, and in my initial phases of my career, there's not a lot of due diligence you can do on a startup, right? Like when I see people taking months, I go, oh, I don't get it, man. Like there's not a lot of history. Excuse me. It's about the team, the TAM, timing, a whole bunch of these T things, right? And so I found though, I was making some mistakes, and I'd write a check, and all of a sudden I'm like, what the hell am I doing here? This person's an idiot. Too late. They got my money. So I started mentoring first, and I found it was a great way for me to get to know the person, the company, the industry from the inside. And then it's a two-way street for the entrepreneur to really get to know me as well. And eventually the conversation turns to, hey, I got to raise money. And then you have, in my case, a much more informed decision to make, and I'm finding I'm making less mistakes, picking more winners. Excuse me. So I would recommend that to a lot of the entrepreneurs on the call here is, seek out mentors first, and you'll find they'll probably increase your chance of getting money from them.
And I think just to piggyback on that, I think a lot of mentors also have very extensive network of funders and investors in general that they can make introductions to. And once you kind of like actually convince someone that you are you have a proven track record of actually delivering what you said you were going to do, people will be more likely to introduce you to their network. I think that's a really good point to keep in mind for everyone who's planning to raise any equity round, or any round for that matter, or any funding.
Totally. And sorry, I was going to add one more comment I forgot, but also Vancouver is a small fish pond, right? And it's growing. There's a lot of people have exits and money now and time to help the next sort of entrepreneur generation. But think globally. Like, there's a lot of money out there globally. When you look at it, from that perspective, like, there's rich people all over the world. They got money and they just want to make money, right? And so for a lot of our businesses, we actually fundraise all around the world. And so and that's a separate conversation to how do you start building that sort of a trap line. But if you think globally, like, you'll probably, if you got a good enough deal, you can always find the money.
For sure. So on that note, I'm actually curious, the three of you work with multiple entrepreneurs, both on kind of portfolio perspective as well as advising or mentoring or just general coffee chat. What are you looking for when you're sitting down with someone? Like, when you're actually thinking about writing a check or saying yes to their business, or saying yes to the investment of your time, being like several hours a month to actually help them. Why don't we start with you, Mark?
Just FYI, for some reason, I can't hear Praveen when he talks, but I heard Manal perfectly, and she was absolutely spectacular, by the way, in your answers to everything. So kudos. Praveen, I'm sure you were absolutely spectacular as well, but I don't know. So the big thing for me is the willing to be flexible. Manal was talking about this earlier in the aspects of, are they open to listening instead of closed on one way of thinking? So working with a firm out of California that has $1 billion idea, and they are one of the firsts to market, and it's a huge global problem that they are solving, and they will be or could be $1 billion company. The founder is kind of hell bent on not raising enough capital to start the attack. So I'm always looking for an entrepreneur that's open to anything and getting the information in and then evaluating what next steps to take. Because if they're anti-bank or anti-equity or anti-giving up something and only want to go X, Y, or Z, that could be a future problem down the road when they make the mistake, potential mistake, of not doing the right thing. So I'll give you that case in point is that I've got one entrepreneur that I've been talking to that wants to raise way too much, and I've got one that doesn't want to raise enough, right? And it's getting the understanding that, look, there's consequences to everything, and maybe you diversify a little bit if you're wanting to, but do more research. But specifically the one that's in California that I'm helping them with their pitch deck and everything like that, they're not asking for enough. Because they, as Manal talked about earlier, what'll happen is they'll get 16 months into spending the money to realize that 12 months in, they're going to have to spend all their time raising more capital. And that's the worst place to be, is to take on money and then quickly, as soon as you raise it, need to go and spend more money and time raising more capital, right? That's why I prefer angels over friends and family, because an angel will give you more money than friends and family who will bother you in 2 weeks potentially on what you're doing. An angel will give you at least enough potentially, if it's the right fit, to do X, Y, or Z. So I think I've answered your question there, and hopefully I haven't duplicated what Praveen said, because I know he said a lot of intelligent stuff, because I saw a lot of smiling and nodding heads. Anastasia, you're on mute again.
I'm a bad moderator today. My apologies, everyone. Thank you. Like you're all good. You're not duplicating. What about you, Manal? What are you looking for?
Yeah, I will add, I think, Praveen, I can hear you and I agree with everything that you're saying. So I think all of these are very complementary ideas. On fundraising and, the entrepreneurs not wanting to fundraise, I'll just add, I don't think anyone starts a business because they think they're really good at what they do well. Unfortunately, it does become like a second job. And so what I would say is that you kind of have to find ways to enjoy the networking aspect of it, and figure out what you get out of it. And I think that's the most genuine way to do it. And I think, to what Praveen and Mark both said, it's true. You kind of, you can't just think right now I'm fundraising, so I have to do this, and then I'm not going to think about it again. You want to be networking and putting out those ideas all the time, because you never know where those things are going to come from, where your next investor might be and who might really be able to help you, whether it's with capital or pivoting to something that takes your company to the next level, or changing ideas when, something isn't working. And so what I really look for in people that I end up mentoring are people that are interested in genuinely talking through ideas, because that's where you can make real connections and actually try to build something. And if that's not there, if you're kind of just looking at it in sort of a transactional, I'm trying to get money, then come on in, apply to the apply for easily. You can get capital really quickly, and you can move on. But for those mentorship opportunities, I think you have to find some genuine interest in things that you can build on together. So I'm constantly looking for people of that kind, people that have an open mind, are coachable, looking to expand what they're doing and think about different things.
Great, thanks, Manal. Praveen, you've invested in more than 100 companies. Is there a pattern to your investment? Is there specific criteria that you're using when you're meeting with someone?
Yeah, so I mentioned it earlier, like with startups, and our family office, we tend to invest in more, advanced companies that are in revenue and need growth capital, but going on a more earlier stage. As I said, like there's not that much due diligence you can do. And so, so to use a poker term, to me, it's table stakes that the entrepreneur is going to be hardworking, driven, smart, all these different things. But the X factors are vision and passion. Like that's what gets you excited to be one part of this, team and dream and help, figure out how to make it a reality. And I think Mark's touched on it too. So I love entrepreneurs that are coachable. And there's a Chinese expression, the teacher will appear when the student's willing, right? And so a lot of the people I end up like they're just hungry for the information and the knowledge, and they're making notes, and then you meet them a few months later, they're applied, which is really important, applied what you've taught them or showed them. And so those are the ones that you think, this is great. Like they're not wasting my time. They're actually moving the ball, right? And then, traction and revenues is always good, right? Because every business plan has that hockey stick growth curve. Like they're identical. Like you lay every business plan and change the name of the company, they all do that, to the right. And so, I've had some success with some companies in the past, and I'll give you a couple of stories. So in Victoria, there's a company called Carmana, which we helped build into Canada's largest solar company. And another company called Coastal, or Clearly Contact. So I was their very first investor. And both of them, the entrepreneurs had bootstrap, credit cards, whatever. And they had 3 years of some traction. They each did about 750 grand in revenues, 1.2, 2.5. It was almost like a double. And so when anybody sees that, not just me, you're thinking, oh my God, someone's done that much on so little, on fumes. And if you actually give them some proper, capitalization, you can see how they're going to hit the rest of the curve. So that traction momentum, you can see how you're going to, keep going. And if you don't have like 3 years of revenue growth, maybe you've got, 3 or 4 quarters of revenue growth. And if you don't have that, maybe you got 4 or 5 months of right? And just the further you're to the right, the greater the chances of getting the financing, and the better the valuation. And so you can get it, down more on the left, but it's just going to, cost you more. But on that note too, there's different types of money. Like there's money for the sake of money, and there's a spot on the cap table for that passive dumb money that will often just leave you alone. But I always advise entrepreneurs to go for that smart, strategic, value add money all day long, because it's just going to try and help itself by helping you over and above and beyond the money. Like, and that's why I tell my entrepreneurs that I invest in, I go, look, my 25, 50 grand or whatever, it's not going to change your life. What's going to change your life is my advice, guidance, and contacts, right? That's what you really want to tap into. And, the thing with fundraising too, like these windows in the markets open and close. And when there's a funding window, you have to jump through, because if it closes or the economy goes down, like good luck trying to get the money, right? And so I'm a big fan of taking more money when it's being offered and available versus, worrying about the extra dilution. Because if you think you're building something that's going to be really big, that little bit of extra dilution at the front end won't make a difference at the back end, right? But just the certainty of having more money and give you more options and choices and rainy day, money.
Absolutely. And I think kind of like for those companies that are still fundraising, especially ahead of the US election, if you're being offered more money, take it. We don't know what's going to happen with investment after that. So kind of like I still have a couple of questions for the panelists, but I can see that the chat function is booming. So why don't we pick one of the questions there? In similar vein, when it comes to kind of like fundraising, this is a question from Thomas. There is a ton of money out there, reach out, but where are these platforms where startups can submit to VC and VC can actually take a look at the deal flow? Or what are your advice? Like, I will rephrase Thomas for you. How do we as founders get our pitch deck in front of VC in order to raise a round? So I'm gonna, Praveen, are you muted? If not, maybe we can start with you.
Yeah, for sure. So, unfortunately in life, a lot of it is not what you know, but who you know, right? It's true, right? And so you can go through the info at a lot of these venture capital funds, and they're going to have some young analysts that's going to look at it, maybe, right? But the best way is to network in and use like you're whoever and use LinkedIn. LinkedIn's fantastic. Like I never really used to use it, but I use it every day now, right? And so try and get a warm referral in. And I do this on the business side for the entrepreneurs I've invested in, because one of the big things they need help with is sales and marketing and business development. And so I go, look, I'm going to use my network to get you in through someone at the top, usually somebody at the C-suite, because otherwise you're going to do a cold call from the bottom of the top. Like, good luck, right? And so I'll phone someone up at the C-suite. They may not meet you, but they'll find the right person to meet you. And now that person's going to meet you and take that importantly, because it's coming top down. And so with that door open, if you can seal the deal, like, we're both going to be happy, right? And so it's the same thing in the investment world. Like, just figure out some way to get some kind of warm referral into anyone, right? Especially someone at the top.
Absolutely. And just kind of like on that note as well, a lot of the people that you already work with, your IREP reps as well, they all know investors. So if you have actually built good relationships with them, you have good traction, they would be more than willing to actually pass along your intro request to these people. So Mark, what about you? Any advice for kind of like how to get in front of an investor?
Well, it all depends on how big your network is to start. That's the challenge, right? I mean, really, you want soft introductions to begin with within the vertical that you're planning on attacking. And again, I go back to investment can come from outside the city you live in, right? You don't have to think about just your city. For instance, if I was to start a business today and start raising capital, my entire network that would be in California would be the place I would start. I wouldn't start in Vancouver. I wouldn't start in Canada. I would start right in California. Because if the idea is good enough to get in front of the right VC or angel investor or whatever, then your network's what's going to help you get there. The funny thing was at Elastic Path is that within about 3 or 4 years, we were being called pretty much every second or third week by people wanting to invest money, right? So once you start getting rolling, you'll find that you'll get tons of people talking to you about giving you money. And then it's a bit of a challenge in the aspects of dealing with the minutia, figuring out who's the right fit for you. So again, you have to go back to your network and say, okay, what do you hear about these guys? Do they understand the vertical that we're in, etc. So it's kind of like sales. It's really about figuring out your roadmap to success and who along the road can get you to the right people, investment wise. So that starts by looking at your LinkedIn and look at who you're connected to, people who are entrepreneurs. It's talking to angel investors. It's talking to other equity firm people that you know, or bankers. Your bank's a good place for resources. It's about leveraging your network and going to things like this and then reaching out to people like me and saying, hey, I'm doing to do with this. People are actually quite good at helping. So don't be afraid to ask for help in that, and say, hey, listen, I'm looking to raise this. I saw a couple of posts in here about people who are not quite yet ready to raise. Well, just let people know on LinkedIn and just say, hey, listen, I'm, an entrepreneur. I've started something up. I put some money in something. What's your thoughts on this? Hey, this is what I think. Boom, done. Right? You'll get response. So your network is your key, to me, to success. That's where it starts. Yeah.
I will add to that. Once you actually secure the meeting, be very direct and be very clear with what your asks are. There are so many times I've heard people so there was a question earlier about whether or not investors are really willing to actually mentor and meet for coffee and all that. They are, like, that's literally their job. They have to meet with companies and they will be more than willing to actually sit down with you. Whether or not you get the second meeting is how the first meeting went. So you make sure that you come to the meeting with a clear set of questions, if you have a list of questions, and do not waste your time. Just be ready for the meeting and do your own due diligence. Like, what are the questions that you want to ask based on that person's experience? So that I would add on that tip to kind of like how to actually get your deal in front of an investor. And Mark was absolutely right. Use your network, events like this. So the chairs of this event, Vivian and Caddy, are actually very well connected in the ecosystem. Use them, like, get connected to them, tell them about your business. It can go a long way.
And if I could just add something to what Mark said, I like to lean on my professional advisors. So the lawyers, the accountants you use, they're providing a great service for you that you need, but I always ask for more. I feel like, because there's a lot of accountants that want my business, a lot of lawyers that want my business, but, help me with some introductions, right? So that's something to talk about. And then, what was I gonna say? I lost my train of thought. Sorry, Karen.
Well, I'll add, I don't want to be repetitive because I completely agree with what Praveen and Mark said, but another thing to consider is also pitch competitions, because especially when you're at an early stage, a lot of what you need to do is just get your ideas out there and bounce them off of people and really hone what is your pitch and what is your message. And so you shouldn't discount those. That's a great way to kind of really craft what works and what will have traction in the market, and also get a lot of exposure to a lot of people. They're also, at an early stage, a good way to raise little bits of money. And so it's just something to add. It's a good thing to participate in. And now, with the way the world is, maybe more and more of them will be online, and they'll be easier to participate in and actually get your ideas out there.
Absolutely.
What I was going to say, and do your homework on who you're going to be approaching, right? Because, like, I mentioned, I do mining and resource deals, right? And so there's a lot of people I wouldn't even approach about a mining deal because their eyes would glaze over, right? So do your homework on the type of companies and industries they invest in, what stage, what geography, that kind of stuff. So, because you don't want to waste your own time and obviously not their time as well, right? So definitely do your homework. And I'll touch on it too, like, you want to be prepared, right? So you have your data room, you have your, your deck, your financials, material contracts. And then when you start engaging with someone, you got to be responsive. Like, it presses me like heck when I review stuff, answer a question, and boom, they reply back. But when you wait 2, 3, 4 days for the answer, you're like, man, these guys aren't prepared, right?
That's good. Thank you, Praveen. Next question is actually for Manal. Manal, how is Easily different? How would you expand on how Easily works with Shred credits? So Manal, you're on mute.
Yeah, when we started Easily, took a look at sort of what the landscape looked like and what people were offering around it. And a lot of what we saw was very high interest rate bridge financing. And so it kind of, they were automatically putting themselves sort of in a lender of last resort category. And what we thought of was, well, actually, like I said earlier, you know, you can use this type of government financing at whatever stage of your company. And this is already available to you. All we're trying to do is make it easier and make it more valuable for people. And so we looked at some of the pain points around both Shred financing and Shred, and a lot of it has to do with the amount of time that it takes and just the effort of being able to get this, what's relatively small amount of money compared to, you know, if you were trying to raise equity and what that would look like. And so the way that we think about it is really, it's a standard process. It's very transparent. You can enter it at any time in your fiscal year, in your company life cycle, as long as you're receiving Shred refunds, and you can get approved and get that first advance in 2 weeks. And then after that, each quarter, it just takes a couple of days. And again, I would say that a lot of that is based on the company. And so companies that are well prepared because they understand that they should be, their financials are up to date, their cap tables are up to date, and they know what they're doing in terms of Shred eligible activities, are the ones that are going to be able to use this in the best way possible, in the most streamlined way possible. But our goal is really to make as transparent a process as can be. And I will just add, since you know, I imagine most people here are from BC, that we also fund the Interactive Digital Media Tax Credit in BC. And we're constantly looking to expand and looking at other programs that we can add to this in a similar way.
Got it. Thank you, Manal. So essentially, kind of like what I would say to founders who are looking for capital, essentially to grow your business, is don't just take a look at one side of the capital. It's not just friends and family round or angel round. There are pitch competitions. There are non-dilutive funding, such as Easily, that you can take a look at out there. There are lots of government grants. Innovate BC has a very good list that I will ask one of my team members or the Vancouver Startup Week people to actually take a look at. And if not, I'll make sure to share that with you via email. If you just like drop your email addresses, and I can drop my email as well, so you can email me after, we can send you the list of funding that are available out there. So this is the last question for our panelists. Say you are a growth stage CEO of a growth stage technology company. What are the different financial instruments or funding sources you will want to have in your capital stack? Manal, can we start with you? You're on mute.
Like I said before, you know, I think at every stage you really need to consider what is important to you at that point and what are the costs associated with those various options for you. Growth stage can actually mean a lot of different things depending on what industry you're in and what the company is. But I would add, you know, I think we've mentioned this before, that there are a lot of things from the spectrum of grants to equity, right? There is convertible debt, there is, you know, straight debt, and even within debt, there's actually a lot of different ways that can go down. And to be fair, actually, even equity, we're both kind of bundling into one thing, but equity itself, you know, what that offer looks like, what that contract looks like, and how it affects you, there can actually be, there's a wide spectrum there. I feel like you can probably have a whole other session just on breaking down what do equity offers look like and what do they truly cost you. And so I think at any stage, you really don't want to put all your eggs in one basket, and you want to look at that entire spectrum and just remember that cost comes in various ways. And in the beginning, what you have more of is, well, I mean, I don't think you necessarily have more of time, but because you don't have a lot of value in your company, people are going to expect you to put in time in order to get money out of it. And later, as you have the company's worth more, you can, give parts of the company in order to be able to raise capital, and you don't have to give as much of it. But just remember, there's always, some trade-off. And it's not as simple as what is the interest rate or what is the percentage of equity that I'm giving up. You really need to look at how is it restricting you in other ways? What does this mean for your next round? If it's investors, are these the right investors that are going to help me get to the next round? If it is debt, is this encumbering my ability to raise additional debt, or is this going to encumber my ability to raise equity later? Is this going to turn into warrants? You have to really kind of learn to dig into these legal docs and understand what is the true cost. What am I giving up? And again, with all of that comes the cost of your time. And what is that worth to you at the different stages of where you are in your company?
Thank you, Manal. Praveen, what about you? Any favorite kind of portfolio of capital stack that you would prefer?
Yeah, so if you're fortunate enough to have a more advanced company, you definitely have a lot more options. And one that we haven't talked about yet is SaaS financing, right? So there's a lot of companies that have popped up now that will fund against the recurring revenue, right? And I love debt. I love the leverage of debt. Interest is so cheap, right? Interest rates are so low, and so if you can get some bank debt, it's a double-edged sword, right? If there's some personal guarantees, you're gonna have to pay it back, but debt can be cheaper than equity. So that's something that I would look at as well.
Perfect. Thank you, Praveen. Mark, last but not least, what would yours be?
Yeah, so the big thing to me is it TBD, right? To be determined, associated to the whole environment of what's going on, right? So I think Manil and Praveen are probably saying the exact same thing because they've complemented pretty much, and we've all been on the same page since the beginning, right? So there's no outlanders, here, or outliers here. The big thing for me is leverage. Even in your personal situation, my father told me at a very early day, don't put your mortgage in your banking. Always keep the toes of the banks on edge that you can move at any point in time. Leverage is huge. Whether it's debt to equity opportunity, whether it's, equity, whether it's government, you're taking money. You never really want to be in a position where one entity has all the power over you, because that is a very dangerous place to be. When we were in the early days at Elastic Path, we had an opportunity to take on a client that would probably take on 80% of our revenue. And we tried to lose the customer because we didn't want to be in a position where one customer could have so much power over us. The funny thing was, in trying to lose the deal, we ended up winning the deal. But that's not the point. The point is that you never want to be in a position where you're completely out of control. You always want to have the option to say, well, I can just go over here. If you don't treat me properly, I can just go over here. So to me, leverage is the big thing. The ability to at any point say, no, I'm going to make an adjustment on plan. If possible, right? That's if possible. So that's kind of my thoughts on, if I'm a high trajectory company, I want to leverage as many different choices as possible so that I stay in power as much as possible.
Great.
And the power
Perfect.
position.
Thank you, Mark. Well, Mark, Manal, and Praveen, thank you so much. We're very grateful to have your insights today, and I think our audience did as well. As you know, there are still a lot of different financial instruments that you can tap into to actually grow your company. So thank you for those who have been dropping their emails. My team and I will be in touch with you to send you the list and resources. If there's anything else that you would like to share with us, feel free to do so. I put my email address in the chat as well. I hope that you enjoyed the conversation as much as I did. And this might also give you a lot of homework in terms of Googling and understanding the different resources that are out there. So feel free to do so. And if you have any other questions, again, feel free to email me and I'll do my best to answer or pass it along to people who can best explain that for you.